There's a lot of talk these days about currency wars as the US dollar depreciates and the Asian currencies appreciate. But what impact will this have on the US and global economies? Our editor-in-chief Terry Wooten sat down with Marc Chandler, the Senior Vice President of Currency Strategies for Brown Brothers Harriman in New York.
If we're headed for a currency war now, we're in the middle of a currency war now, it has very negative implications for world growth, and of course the U.S. needs world growth because this is one of the ways that we're going to grow faster as well. But I think the good news in a way is that I don't think we're in a currency war. A currency war would seem to require a couple things. One, it requires retaliation. So far, the countries that are protesting the strength of their currencies, it's not really prompted a retaliation. An example of what it would look like is Fred Bergsten, a well-known economist, a trade economist in Washington, D.C., had a piece in the Financial Times recently, and he said when Japan buys $25 billion, intervenes in the foreign exchange market, the U.S. should do the exact opposite. We should sell $25 billion in the foreign exchange market. That would be a currency war. Yeah, so in big picture then, I think that the best thing to improve the U.S. trade balance is not by having a lower dollar. In fact, I would argue along the lines of the U.S. Treasury that what the world suffers from is not a U.S. trade deficit, but insufficient growth. Our fastest growing trading partner right now, where U.S. exports are growing the fastest, is the currency that we keep complaining about is too weak. China.
There are a lot of people now that say that the Federal Reserve is printing so much money and that we had stimulus programs and we really, all this is going to, cause an end to capitalism and we should go back to laissez-faire. What do you think about that?
Yeah, it's an interesting argument. I mean, a lot of people on Wall Street are very sympathetic to it, of course, but I think that's not really true to history, in the sense that I don't think we've ever had laissez-faire. So there's sort of like this golden age that I don't think really ever existed. I think about things that tax policy that we think is not really government intervention, where they give us a tax break for things that we would do anyways, like the interest, our mortgage interest, tax deductible. This is the government intervention as well, and I don't know. For me, there's a very fine line between laissez-faire, minimal rule for the state, and anarchy.
You wrote a book recently in the last couple of years called Making Sense of the Dollar, Exposing Dangerous Myths About Trade and Foreign Exchange. You list 10 of those myths. Which one's the most dangerous? Is it the one about trade?
Well, I think that in the current environment, I'd say the most dangerous myth is people believing that the way to correct a U.S. trade deficit is to have a devaluation of the dollar. I think it really misunderstands how U.S. companies compete in the world economy. I think it misunderstands what really drives exports. So first thing I would say is that the real way that U.S. companies service foreign markets is not by exporting. That's sort of what, say, Donald Rumsfeld might have called the old European answer. The modern answer, the way the U.S. does it, is by primarily building locally and selling locally.
Stay on top of the latest market activity with Kitco News on kitco.com. Thanks for watching.